podcast where we put you on the map. This is Ron Costa broadcasting live from the Mappable USA studios in Las Vegas, Nevada. And folks, today we're going to talk about the number one concern investors have through all this crowdfunding. Everything that we talk about today, we're going to put it all together for you in a nice yellow bow. So before we do that, let's introduce Vicky Muchmala from the World Token Market. Vicky, how are you doing today?
I'm doing so wonderful, Ron. I can hardly stand myself. Beautiful, perfect day in Vegas. We've got an excellent guest on this podcast. Let's get started.
Yep. Let's bring on Mike Brette from Small Cap Equity Advisors. Mike, how are you doing today?
I'm doing well, Ron. Thanks for asking.
Absolutely. That's great. Mike, it's great to have you on. I know you've been on the podcast many times before. We love the content that you provide, and I'm really glad that you made yourself available to us again today. So
yes,
thank you very much.
Thanks again for the opportunity. I appreciate it.
Great. So again, people probably know you at this point, but if in case they don't, can you do a really quick review about maybe your background and what Small Cap Equity Advisors does?
Yes. I've been in business over 25 years as a consultant advisor to publicly traded companies and private companies, helping them to access the capital markets. I do road shows before we had this lockdown. I did road shows all across the country, a lot of them in New York and on the East Coast and here on the West Coast, where I would bring my client and they would present to 25 retail and institutional investors. I do Reg A plus financing for publicly traded companies. I've published 2 books that are still available on Amazon.com, and I am trying to finish up my 3rd book, which I hope to have done in 6 to 8 months. Get it done, and it'll be on Amazon as well. It'll be a follow-up to my book of how to raise capital for your business. And as I said, I take companies public. Either through a Reg A Plus offering, direct registration, or S1 registration, and to help them build their shareholder base, build some stock liquidity, and most importantly, I help them raise capital. And I've got my doctorate degree in law for 42 years, and I just like what I do, and I've been doing it for a long, long time. So I appreciate the opportunity to be on your show.
Yeah, that is a long time. It seems like you got your hands in a lot of things, and of course, it's all good for both issuers and investors. But today, I thought maybe we could talk about investors when they come to the table and they see crowdfunding deals, or they see deals to buy stock or equity, or a syndication deal type of stuff. What their biggest concern, obviously, is how do I get out of this if I have to, or when do I cash out? I mean, is that something that your clients ask you right from the start?
Oh, yes. I mean, I've heard that even before crowdfunding, was passed in the Jobs Act. It was, investing in a private placement that, with a private company. In my industry, we call it dead money because, there was just no way of getting your money back until either there was a public offering, or somebody came in and bought the company out, or there was a redemption, by the sponsor. So that's a very good question. And I do get it all the time, especially with the crowdfunding, because, a lot of the CF crowdfunding deals are from true startups. Many of them don't have revenue, and they really don't have an exit strategy that's close at hand. A lot of them are raising, $500,000 to $1 million to get a prototype going, or, some startup operating capital. And, investors putting in, I know the threshold is low. Some of these crowdfunding, it's $500 or $100. But if you invest in 10 to 12 deals and everything, the money starts adding up no matter what the dollar amount. And there really is no exit strategy close at hand. So I tell clients, if you're going to consider investing money in a private deal, again, read the paperwork very closely, ask questions about how you can get your money back and the time frame, and is it dependent upon somebody coming in and buying out the company? Is it dependent upon the sponsor of the deal dictating when you get your money back? And if you can't wait a certain number of months or years, then you shouldn't invest in a crowdfunding, no matter how much or how low the dollar amount is, because an exit strategy is critical to many investors.
Right. So if you're looking at a syndication deal, let's say for a real estate project, let's say, for example, there's somebody doing a multifamily and they're looking to raise, X amount of money, whatever it is, but they're starting it from scratch. So they're looking at projecting 3-year construction or whatever it is. Investors won't see money until about, let's say, 3 years. I mean, that's like, $75,000 to put into that, $100,000 to put into it as an investor. You got to be thinking, there's got to be a way I can do something, unless this is a publicly traded entity, which they're not. But what do you say to a syndicator who comes along with that and says, Mike, I got an opportunity for you here. This looks like a great deal. We need $75,000 for an investment, but you're not going to see any money back for 3 years. I mean,
yeah, that's a very good question, and that's why in my business, I only work with publicly traded companies, either companies that are public now, or they contact me and they want me to take them public. Because in today's market, investors are looking for a return. They're looking for a return of their principal, and they're looking for, I don't want to say just flexibility, but they're looking for creative ways that they can make money and they have control of it. Now, with a public company, if you make an investment in it, you get shares back from that. If you invest in the open market with a public company, you can get out anytime you want. If the stock goes up by 50%, you could sell your stock and get your investment back. So the investor is in control of when he can get his money back. With a private company, you have to look very carefully at the deal structure and the terms, because if you've got to put in $75,000 or $100,000 and tie it up for 3 years, that really has to be discretionary money that you can afford to lose, or that you can afford to invest and not, be concerned about getting it back to put your kid through college or for emergencies. So it really has to be discretionary money in that example that you just painted. I don't like those kind of transactions, and I over the years I've done my share of private deals, and I have a safe full of private stock certificates that look fancy on the wall if I were to put them in a frame. But that's about it. So I kind of learned the hard way that I don't personally invest in private deals anymore, and it's really difficult. I mean, somebody that's considering doing that deal you described really has to not want their money back for 3, 5, maybe 10 years before there's a return, especially in this market. With the pandemic, commercial real estate is really taking a hit in a lot of areas. I know here in California, in San Francisco, Los Angeles, New York is devastated with commercial real estate. So, and even residential apartment complexes, I mean, the rents are down 50% or more in places like New York. So again, the investor really has to take a look at the deal and can they afford to tie their money up for that length of time.
Yeah, a lot of times they're not even getting. They may not even be getting their money back. They may just be getting rental income or whatever based on a proportion of their ownership. But these investors that invest in, let's say, a syndication deal, they don't have any say into when the project is going to get sold, right? Doesn't the sponsor determine that?
Oh yeah, in most cases, yeah, they don't. The sponsor who's putting the deal together wants the money for the project, and they're not going to offer an interest rate on your money, while they're building out the project and everything like that, because that takes money away from building the project if they have to do a debt service. And ideally, if you're an investor in a deal like that, and the syndicator or the sponsor is offering you, let's say, a 10% interest on your money until the project is built, well, at least that's something. But I would be very cautious of a deal like that, because syndicators of those real estate deals, they need all the money that they can possibly raise. And if they don't have cash flow coming in, because like you indicated, this is a syndicated deal from the ground up, so there's no rental income, there's no cash flow from the project itself. So how is the syndicator going to offer an interest rate or rate of return? So again, those are some details that they always say devil in the details. The investor really has to ask a lot of questions before they get involved in the deal. And again, the experience of the syndicator goes a long way to give you that level of confidence. I mean, if the syndicator of this real estate deal has been in business 20 years with a very successful track record of actually building the projects, getting them fully rented, and returning investor capital, well, that's a comfort zone or a comfort level right there that some investors might not hold up their investment or something like that. But if it's somebody just starting out, you really got to look at it with a jaundiced eye.
Have you ever seen
you always have to do your due diligence. You always have to make sure who you do business with, no matter what it is.
Yeah, and you really, a lot of investors, have money, but they don't really take the time, like you say, Vicki, do the due diligence. They just listen to the presentation. They cursory, they go through the business plan in a summary manner, and here's my check.
Yeah.
They really don't do the due diligence. They really should pass it off to maybe, like in the case of a real estate deal, even though that person may be a sophisticated real estate investor, they should still pass the deal off to their real estate attorney or other financial advisor for them to take a distant look at the deal and everything like that, so they're not so close. Sometimes when we're investors in a deal, we tend to only look at the good things and just put the bad things in the back and ignore them. Well, you pass it off to a third party, you kind of take their advice or your advice, and then you make a decision from there.
Exactly, because it's always nice to have a third party look at the deal as a whole, not just because when you hear a presentation and somebody's real gung-ho about their project, of course they are, and they pass that enthusiasm on to you, you get a little blinded by the enthusiasm. You need somebody to look at it as a whole and bring you back down to reality and say, yes, this is good, no, this is not, wait for something different.
Yeah,
you're
absolutely correct. Always having somebody from an arm's length, transaction and taking a look at it is always better than, the more eyeballs on a deal, the more comments and criticism you get. You get more information to make an informed decision. And again, public deals are a different story, because you as an investor, if you're buying the stock in the open market, you have control of when you want to get out of the deal. You just watch the stock and sell. Private deals, really, again, they hinge on the strength of the syndicator and something like that.
Yeah. Have you ever seen a syndicator where they will buy back a certain share where, if you have some kind of problem where you need the money immediately? Are there any indications that they might be able to do that for you, or is that something that they don't really do?
In 25 years, I've never seen it.
Wow,
that's not to say that an investor can't insist on it. In other words, if let's say the minimum investment is $100,000, and the investor is going to put in $1 million of his money, with his attorneys, he might be able to put together a different type of investment contract that's more favorable, to him as the investor. But the standard agreements that I've seen over 25 years usually give all the power and the authority to the sponsor, syndicator, the one making the offer, and the investor really has little say-so in it. Because if you read a private placement offering document, in it says you acknowledge that you can withstand the risk and loss of all your money. You know that there's no secondary market for this investment, that you're putting it in. Blah, 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 all these boilerplate provisions that really favor the syndicator and, the sponsor of the deal. So, and most investors don't think they have any negotiating power over that. But, the golden rule is the guy that's got the gold rules. So, but a lot of...
Well, which goes to another reason why you should know what your leverage is and have your attorney and your financial planner help you with the deal so that you can negotiate a better deal than the boilerplate agreement that everybody else is signing.
Yeah, that's true. And again, you'd be surprised. I think we mentioned this on one of the other shows that we were talking about. You would be surprised at how many people get involved with a private placement and never have an attorney or other financial advisor read the private placement document, which, in some cases could be 50 pages, and a lot of legalese in it, and, a lot of escape clauses. And, I mean, a PPM is really a disclosure document to protect, the issuer.
Absolutely.
And it's a lot of disclosure information, but you'd be surprised how many people write a check based on the hype that they hear from the issuer or the stories, or maybe they go to a seminar and they hear only the good things about the deal, and they never actually read the paperwork before they write a check. Yeah, it's amazing. I mean, it's just incredible.
That it's just mind-boggling to me that anybody would put in a large chunk of money into an investment and not read the paperwork, or have somebody read the paperwork for you if you can't understand it, just to make sure that you're not swept up by the emotion of the project and that you're actually doing something that's going to be to your benefit in a year or two or whenever you're ready to get out of it. I don't understand that concept. Yeah. I just can't compute it.
Yeah, I mean, it happens. It happens more than you would think.
Sure.
Because people just get. I mean, they'll get an investor deck that might be 15 pages that only talks about the good things, the glowing reviews of the project.
Oh, yeah.
And then when you get the private placement document, which is 50 pages of legalese, they don't read that. They just sign it based on what they read in the business plan or the deck, and it's a shame, but it happens. It happens to a lot of people, and it's just the way the world is. But with the crowdfunding, then you could, go. I mean, Regulation A is a part of the crowdfunding also, but in the crowdfunding, in a Regulation A, whether the company goes public with a Reg A offering, the stock that they get in that offering is free trading. In other words, like in your syndicated deal, Ron, you were talking about, if that was structured as a Reg A offering and an investor would have put $75,000 in and get shares back, those shares can be resold. They're free trading. So that person, if they get pressed for money and the syndicator won't buy the shares back, they could always sell them to somebody else that might be interested in it. So there is a protection element in the Reg A offering, again, whether the company goes public or not. But if you buy stock in a 506C private placement, those shares are restricted. You can't do anything with them. You can't hypothecate them for a loan. You can't transfer them to somebody in a barter transaction. You can't resell them. So I always tell people, look, just take a look at the paperwork.
Yeah. Is that why a lot of people who are doing Reg A will go the Tier 2 route, because it's the fastest way to be listed on a publicly exchange?
Yes. Yeah. It's going that way more and more now that people are looking at valuations of companies more closely than before. When the Reg A was first in the Jobs Act, when it was first came out, a lot of valuations just were sky high and came crashing down when the companies, actually started trading and people found out what the true value happened to be. I mean, a stock could be trading for $7 a share, and 90 days later it's $1 because the valuation initially was way too high. So, but that's all been cleared up, and more in most cases with a true valuation. But yeah, it is a good process. I think we talked about it in one show, as opposed to doing a reverse merger into a shell to go public, where there might be some excess baggage with shareholder lawsuits and debt and things of that nature. With a Reg A, it's a clean exemption from registration, where you start from scratch, you build your own shareholder base, and you have control of the dilution for the issuer. So it's a way I'm taking companies public now. I've got 2 deals right now that I'm taking public through the Reg A process, And once we get them listed on OTC markets, then I've got an investment fund that will come in and supply some capital because it's a Reg A public company. So I always try to steer clients in that direction. But, again, with the crowdfunding, a lot of that with the CF crowdfunding is for startups or people that are in a, like an angel round or first round of financing, and that's why they're using that. But they really need to keep in mind and build in some kind of an exit for their investors.
Yeah. So on a Reg CF, for example, which I believe now you can raise up to $5 million. Is that the new threshold? I believe?
Yes.
Yeah.
Yes.
Okay. So now you could raise up to $5 million. In the documentation on the Reg CF, you'd have to make it clear to your investors that the intent is to bring this to a publicly traded vehicle, right?
Well, I'm not really sure you could you could say it's the intent of the company, depending on market conditions, that we're looking for an exit strategy, either as somebody will come in and buy us out, or the intent would be to go public at some point in the future. But that's not really binding. You can't, as an investor, you couldn't unless they came out with a firm commitment saying we're going to go public within 18 months after this crowdfund offering. You don't really have much to hang your hat on, but it's always good for the issuer to state something as far as a potential exit, and that's what they need to check with their SEC attorneys, because all these crowdfunding platforms, the back office is basically it's a licensed broker-dealer that helps supposedly do all the due diligence on the deal and make sure the investor is getting a square deal because they're licensed FINRA broker-dealers.
Yeah. Because can you imagine like buying into a project and now all of a sudden you have you have 10 million shares of this company that you're like, okay, all I need to do is go $1 and I'm out, and all of a sudden the project fails. You have like you said, it's a good wallpaper thing. You have 10 million shares of nothing.
Yeah, and that's part of the risk. And again, if you read the PPMs or these private deals, in it says there's no secondary market for it. A lot of things could go wrong and the project could fail and you could lose all your money. And, as long as there's no fraud involved, you're out of luck as an investor. If the project fails, it fails and you lose your money. So, again, Vicki pointed out, due diligence is critical. If you're going to go into these private deals or any deal, you really want to do your due diligence on the issuer, the developer, syndicator. If it's a real estate deal, what's their track record? You've got to dot all the I's and cross all the T's for your own benefit.
And be able to hold on for as long as it takes before you can see that money on the sale. Yeah.
Yeah.
And there's nothing worse than doing a business deal, whatever it is, from an emotional point of view, because anything that you do from that emotional aspect is likely to not go the way you wanted it to, because you didn't do due diligence and you didn't look at it in 360 degrees and plot out the ripples to make sure that it actually is going to work. It's because it looks pretty, sounds good, and he made a really nice PowerPoint presentation. No, that's not the reason you invest. You invest because you've done your due diligence, you checked the analyticals, and you had somebody help you in 360 degrees.
Yeah, and as Ron pointed out, with a real estate deal, a syndicator, I mean, again, it gets back to track record. If the person is just starting out, and this is their first real estate project that they're syndicating, you got to be. I mean, that would be a red flag to me. But if somebody was experienced with a track record of 10 to 20 years, and you could go and look at some of their projects that were already built and rented, and real estate, people make a lot of money in real estate deals, But again, if you're dealing with an experienced operator, a syndicator, it takes some of the risk out, but obviously not all of it. But again, it's due diligence on your part. Ask questions. Don't just sign documents sight unseen, and please don't. I don't know how many deals that I've been involved with, and I'm talking to somebody and I'm saying, who's your legal counsel? Oh, I'm doing everything myself.
Oh boy!
Famous
really?
last words, right?
Oh yeah. Oh really? And where did you get your forms? For your private placement? Oh, I got them online for $300. I just I filled in the blanks and I just said not interested. So, I mean, it's just really sad. That people do things like that. I mean, they think security laws are a waste. That they're not there for a reason. The security laws are there for a very good reason. And you got to follow them,
Right.
So that's what security lawyers are all about.
And plus, you have to know the language. Every industry has a language, and that's why lawyers write documents that are 50 pages long because they use lawyer language that most people don't understand. So a lot of what you pay an attorney for is just to be able to understand the language.
Yeah, and the other thing is just as important. If you hire a lawyer to look at the documents and give their opinion and everything, and something goes wrong with the deal, that attorney should have recognized could go wrong and didn't advise you, you could always go back and sue that attorney and collect money from his malpractice insurance. So you've got that extra layer of protection. That's why almost all broker-dealers and investment banks will not look at a private deal, a private placement, unless there was an SEC law firm that actually prepared the private placement. If the issuer prepared themselves, like buying some forms and filling it out, broker-dealers and investment banks, the compliance department will not allow them to get their clients involved in that deal for the liability issue because they have nobody to go against. Something goes wrong with the deal that's fraudulent or negligent or whatever, they can't really go after the issuer. They'll probably skip town and blow all the money, and there's nobody to go after. But if an SEC attorney law firm prepared the document, they've got that law firm to go back against for their malpractice insurance and get reimbursed for whatever the broker-dealer loses, So it's very critical, it's critical.
That's the exact reason why I prefer to stay poor.
Yeah. Yeah. You can sleep better at night, right?
Yeah, exactly. But okay, so listen, we talked about the 506Cs, we talked about the private placements, the Reg CF, the Reg A plus, et cetera. Have you seen anything in the security token offerings market?
No, I've gotten, I'd say over the last, when it became real hot in the last couple of years, I was getting calls, from people, but you tell them, look, no matter how you want to describe a token, cryptocurrency, whatever, it's a security. Under the security laws as they are now, the SEC looks at it, and if you're promising somebody that if they buy or invest in this token, this cryptocurrency, that it's going to go up in value in time, that's a security. And if that's part of your sales pitch or your description, you need to make this token offering either with a registration with the SEC, like an S1, or file under an exemption from registration under Reg D. It's and I've gotten calls from people, oh no, we're not a security, so we don't have to have any documents or anything like that. We're just using the business plan. And I say I'm not interested. Because that's another one where I ask him, who's your security law firm that prepared your private placement for this token offering? Oh, well, we don't have one because, we're not offering a security. We're just selling an investment. Well, right, there's so many red flags. So I have not seen, I'm not saying there aren't good deals out there in the token crypto area. I just haven't seen quality deal flow come to me. Everybody is trying to do the deal themselves and not hire a lawyer, an SEC lawyer, and they don't have any qualified offering with the SEC. So I've passed on that whole area.
Well, I think there's been a lot of movement in that industry as far as companies trying to develop a secondary market for trading of those securities once they're done correctly via the SEC. And I think if that ever happens, that's going to add a liquidity layer to that kind of stuff that you may not have anywhere else, which I think is kind of interesting. But other than a handful of companies that are trying to get that thing going, I don't know if it's out there at this point as far as the secondary market is concerned. But I think it's going to be a big win for investors when it does happen. I
think it will be too. Once it's like any new industry, and I know the token had been around, in some form or another for 10 years, Bitcoin and things of that nature. But I still think there's so many gray areas that it needs to mature as an industry. And like you said, it has to elevate itself. It's got to get, like an exchange, like the NASDAQ in New York, and it's got to have regulations so that investors are protected, disclosure requirements, and things of that nature. And once it gets to that level, I think it's going to open up a whole new market for everybody.
Oh yeah. And it's starting, and plus people have to learn about it too. People have to have faith in it and trust in it and know that it's not a scam, that it's a legitimate thing, and that it's developing, and there is a potential into the future. Because I believe that the blockchain is something in the future that will disrupt so many industries. But as you say, there needs to be more development and fine-tuning of it before people are more comfortable to go into it and invest large chunks of money.
Yeah, you're absolutely right, Vicki. Blockchain is here. It's going to mature. It's really going to be an industry to be worthy of investors. I've gone to a number of seminars over the last couple of years, way before the lockdown, and just the promoters, and that's a phrase that I'm using here, the people out there promoting those types of deals just they don't have a grasp of the industry themselves. I went to one that was talking about the cryptocurrency, and I said, how do you establish the value? How can you say that this token is worth $1,000 now, but in a year it's going to be worth $5,000? How do you establish that value? And you can't get a coherent explanation. The explanation I received at the seminars I went to was, well, it's all supply and demand. Right now we're putting we're mining, that's the phrase, a lot of these tokens now, which are going to be on the market, so the value will be less. As we mature, we're going to take some of those off the market, and then supply and demand. The less supply, the bigger the demand, the higher the price. And I look at
that doesn't make sense.
I said, you're talking in circles here. You're trying to establish the value yourself, and there's no rhyme or reason as to what it is. So I think the promoters, you get rid of all the promoters and get some real serious financial people in there, like from J.P. Morgan and places like at Morgan Stanley, analysts that really know the business and can explain how the value is set. Until that happens, I think it's just still going to be a gray area. But eventually it's going to get there.
Yeah, it's like we talked about on a previous podcast that we did with you, how important valuation is. You see some of these Reg A companies that have gone public, and some of them are considered success stories because they were the first to do it, but their stock has plummeted a lot because they didn't set the valuation straight from the start. So if that doesn't work, you're looking at a loser in the long term if you're a stockholder.
Yeah, exactly, and that's why so many of the initial Reg A's from like 2 years ago floundered, because they were just the valuations were so high, saying that it's a pre-revenue company, for instance, the stock is $7 to $10 a share. Give me a break, And so they were selling it at that level. So then when it got to the NASDAQ, it started trading, and analysts and investors started looking at it and determined, hey, this is a $2 stock, not a $10 stock. It went down, and initial investors lost their shirt, and so many of them were like that. That's why NASDAQ passed the rule that they won't take any Reg A Plus offerings to list on NASDAQ until the company has 2 years of operating history with the substantial revenues and audited financials under their belt before they can list as a public offering on NASDAQ. So the regulations are tightening up so they can get rid of that discrepancy in valuations, from, when it was starting out to when it got listed.
Yeah.
And it goes back to having the right professional people helping you develop along the way to make sure that that kind of thing doesn't happen or happen as badly as it could.
Yeah, and companies, you point that out really well, Vicki. That's good because I get so many people contacting me that they don't have any advisors whatsoever. They don't have an attorney. They don't have an accountant, CBA. They don't have anybody experienced in public markets or even private crowdfunding markets. Everybody's trying to do it themselves. They don't want to spend any money. For some reason, this myth got established out there that you could raise millions of dollars without spending any money. No money for legal, no money for accounting, no money for marketing. It's all free. And I tell clients, look, if I could raise you $10 million without you spending a dime, I would raise the $10 million for myself.
Exactly.
Why should I? Why should I do it for you? It takes money to raise money, but for some reason these either startups or even seasoned companies get it fixed in their head that raising capital is free, and they just don't understand. They think if they do a crowdfund offering like a CF, it's free. No, it's not. Legal fees are probably
expensive.
Legal fees are probably $10,000. You got accounting fees on there, and then you've got a platform fee, and then you got to market it. And then when you start telling somebody about that, you ask them, and they say, "Well, we tried crowdfunding, but it failed. It didn't work." So my first question is, what was your marketing budget? Well, we didn't have a marketing budget. We didn't. The platform said they're going to market our offering. Well, that's not true.
No.
The SEC does not. The SEC does not allow a funding platform to market one offering over another. Now, they can put out a press release that says these 10 companies have loaded up their offerings on our platform, but they can't market one deal over another. But you'd be surprised. A lot of these platforms are telling companies, look, if you sign up with our platform, we've got 100,000 investors that we can direct to your offering. That's totally
and
wrong.
Sad. It's really sad because there's a lot of people, they hear the story of the person who started with $1,000 in their garage and now they're billionaires, but they don't tell the in-between part of the story where, I had this fabulous idea, but I had to go through all of this to get to there, and they forget that part. But as you say, you got to spend money to make money, and raising capital is not cheap, and it's even more expensive if you don't have the right professionals helping you, guiding you, and advising you along the way. And if you don't market, if you don't do marketing yourself before you even get to that point so that people know all about you when you're ready to say, okay, now come and invest, you still aren't going to make it.
Vicki, that's exactly why everyone listening to this podcast has to contact Mike right now. So, so Mike, how do they get in touch with you?
They can call me at 951-236-8473. They can go to LinkedIn, type in my name, Michael N. Brette, JD, and bring up my profile, and they can email me at mikebrette@gmail.com.
Excellent. Actually, your last story reminded me of that whole thing about the fortune teller who's going to charge me $50 to give me the lottery ticket winners. She can do it herself. She knows, right?
Yeah.
But yeah, I mean, I'm really glad that we took over this topic today because everybody was talking about this, and the whole exit strategy. It's a really big issue on a lot of investors' minds. Vicki, what do you think about the podcast today? You have any other questions for Mike before we close this out?
I think it was great, and if we did anything, Mike, we convinced people. Whatever your fabulous idea is, don't go forward until you have a good attorney, a good CPA, financial planner, and that you contact Mike because he can help you along the way.
Yeah, I appreciate it. Yes, and that's what people, if there's a takeaway from this podcast, it's get a good team around you, a good lawyer, a good accountant, a good financial advisor, a good consultant, people that have been there, done that. Whether they've made mistakes or not is not important. It's getting the team, experienced team around you to guide you. Not that you have to take what they say as gospel, but you need opinions to help you, guide you. Even if you're experienced, you still need a team around you in order to make sure you make the right choice.
And, a good team around you, not only do they bring their professional knowledge and that to the table, but a lot of times they bring information from the grapevine of the industry, and so that they know who to work with, who not to work with, who to talk about, who's good, who's bad, and that kind of stuff. The average person who thinks they can do it themselves, they don't have that information, and that's as vital as the expertise that a professional has as well.
Yeah, good point, because the contacts, like a good CPA, a good lawyer, consultants, they all have, if they've been in it any number of years and done transactions, they've built up a network that they can bring to the table for your particular deal also. So it's very important. It's money well spent to get a good team around you.
Exactly.
And that's why we do the podcast, so we get to meet great people like Mike. So, Mike, thanks a lot for being a guest on the show today. I really appreciate your time and the information you provided today. Vicki, again, thanks for co-hosting. This has been a really fun podcast. And everyone out there, you're listening to the Mappable USA podcast at mappableusa.com. If you go to that website, you scroll down a little bit, you'll see all our syndication sources. Pick the one you like best and subscribe, and you'll never miss another one of our episodes. If you want to be a guest on the show like Mike was today, there's a guest tab there. Just fill that out. We'll see what we can do about getting you on the show. And if you like what you heard today, send us an email, info@mappableusa.com, or just comment on whatever page that you're listening to this on right now. So thanks again for listening. Thanks for your support. We'll be back at you next week with another Mappable USA podcast. Have a great week, everyone.